question I get asked quite often when it comes to investing in rental properties is if someone should buy for cash flow or for appreciation. These are two investing strategies. Ideally, you want to have both, but here's a quick explanation as to what the difference is between these two types of investing strategies. When you are buying for cash flow, it means that you want to be pocketing some money at the end of each month after your tenant pays their rent. When you're buying for appreciation, you're hoping that property value of your real estate is going to go up quickly and perform well so that when you go to sell it, it's worth a lot more than it was when you bought it. Of course, ideally you want both, but in some markets, it's really hard to have both cash flow and appreciation. And in fact, it's becoming harder and harder to find markets that offer both cash and appreciation. Expensive markets such as Vancouver, New York, San Francisco, where there's land scarcity and a growing population, you're typically going to be buying properties that are undergoing appreciation, and it's going to be very hard to find properties that offer cash flow in the short term. Of course, once you've paid your property down over the years, you'll start moving from not just appreciation but also into the cash flow area. But when you first buy in these expensive markets, your primary strategy is going to be appreciation. So you need to make sure you can afford that. If you're only buying for appreciation, you're not going to have money in your pocket each month, at least not for the first 5 years. In fact, you may even be subsidizing your property. It may not be covering itself. That is a very good strategy if you're in a full-time, high-earning employment situation and you are looking for some tax breaks, because it means you are subsidizing this property, which will be your tax breaks at the end of each year, and you'll be able to cash in on the appreciation one day when you retire and you're not making as much income. Cash flow, on the other hand, is when you are getting some money in your pocket at the end of each month. And today, a lot of these cash flowing properties, unfortunately, are not in markets where there's a lot of appreciation. That gap has really grown over the years. So for cash flowing properties, you're going to be going to smaller markets, smaller towns in British Columbia. Calgary, Edmonton are one of those few that can offer a little bit of appreciation as well as cash flow. But otherwise, you're going to be going into smaller towns across British Columbia and across Canada and even the United States to be getting that cash flow, and you'll be seeing less appreciation. A lot of these markets also have an abundance of land, so there's lots of room to build more, which also limits the amount of appreciation you can have in a specific market. Cash flowing properties are excellent if you're just starting out as an investor, because you're going to look better to the banks if your properties are cash flowing and you want to buy that next rental property. So stick to cash flow if you're new to investing and you want to grow that investment portfolio. Otherwise, appreciation if you are a high earning individual who can afford no cash flow at the end of each month but would really like to take advantage of an appreciating asset in the future. Check out my other videos on the most basic real estate terms that you should be familiar with if you are wanting to start investing in real estate.